just one more quick thing. If you guys have any questions for me or for Jill as we run through the presentation here over the next 45 minutes to an hour, just type it in, and we're gonna hit those questions, because that's really where the fun is. I mean, Jill's stuff is great, and you guys are gonna learn a lot of stuff, but it's more fun to continue the discussion and finding out what you guys want to learn and what you guys are interested in. So what are we looking at in the S&P 500? We're kind of going sideways over here. I don't see much room to go up. Every time we try to go up, we just get rejected by sellers. There's just not a lot of momentum over here in this market. With volatility down where it is in 13.5% area, the VIX was up 3 cents today. It was down quite a bit early, then it rallied back in volatility, and then we basically hit the flat line. That just means there's not a whole heck of a lot of interest at this level up here. Mind you, there's not a lot of interest down here as well either. You know, because look what happened. We got soundly rejected on the downside on the spiders, and let me put the S&P 500 back up. We were soundly rejected down over here, which created that little inverse head on this chart pattern. So, you know, really, we've kind of stalled over here, kind of at a way station, at a point, a neutral, you want to call it, whatever you want to say. This is just a point where it's very difficult to find buyers. It's very difficult to buy sellers. Now that being the case, and I was talking with Jill right before we got started over here, do we really care if we're stock pickers? Do we really care what the market is doing? And the answer really is no. And I wrote an article about this, sent it to our Trifecta subscribers, sent it to Jill as well too. There's something called the Implied Correlation Index, and Jill kind of mentioned this to me a couple of years ago. It was the ICJ, and then it was the JCJ, and now it's the KCJ. So what is this? This implied correlation, right? And basically all you really need to know is the lower this number is, the less correlated markets are with stocks, and it becomes a market of stocks instead of a stock market. And simply put, the less correlation there is, the better chance that your stock is going to move on its own merit, whatever the news is or whatever it does, as opposed to what the market is going to do. Remember back in the days in 2011, right after the tsunami hit, and then all of a sudden we had that meltdown after the credit downgrade from S&P. Remember that back in August? Of course. So what happened then? Correlation started to rise. You have numbers here in the 50s and 60s. We're talking back in October, November. I think Jill will probably agree with me that I think we were like in the 80s, 75, 80, or something like that. But then when volatility started to come out, this bubble of correlation started to implode, right? And we started seeing lower and lower numbers, and the market became much more of a stock picking environment starting in January of 2012, and we've been low ever since.